Record. Okay, hi everyone. Welcome. We'll now have our illustration on how to prepare cash flow statement. I hope this is just a refresher to you. Yeah, so we're not going to do an illustration on how to prepare the income statement and the balance sheet, because I believe that this is something that we must have done before. But in this case, let us refresh and remind ourselves on how to prepare a statement of cash flows. So with us here, we have the following information for Home Limited. We have a balance sheet as highlighted there, and we have an income statement or the profit and loss account, which shows the net profit and the revenues and expenses of the business. And we also have an additional information, as I'm highlighting there, that the company sold building during the year, whose cost price was 36,000 rupees. So with that information, we can prepare a statement of cash flows. So a statement of cash flows must have a header. In the header, must have the business name. So in our case, Home Limited. The type of financial statement, that is a cash flow statement for the year. The period has been indicated for the year ended 31st December 2006. I think that is clear from the dates of the balance sheet and the income statement. There is an immaterial error here. The date in the profit and loss account and the balance sheet are contradicting, are not similar, but anyway, we get the concept. The date has to be there. So we now prepare our cash flow statement. A cash flow statement is classified as three key elements. That is net operating cash flows from operating activities. Then we have net cash flows from investing activities, and we have net cash flows from financing activities. So usually begin with the net cash flows from operating activities. So you can indicate them as A. So net cash flows from operating activities. Operating activities are basically those activities that take place within the business. Normally, the normal activities of the business. So they include sales, they include purchases, they include payment of wages and salaries. That is payment of expenses like rent, like interest on bank, on loans. Yeah, so those activities that take place on a day-to-day basis in the business, like transport, advertising. Yeah, and those activities are usually found in the income statement. Yeah, so like in our income statement here, you have cost of sales. Yeah, and in the cost of sales, you have purchases. Yeah, so those purchases as an activity, they constitute an outflow of money, of cash, and an inflow of goods. Yeah, so cost of sales is an outflow of cash. We have, in our case here, we also have wages and salaries. This is cash being paid to the employees. That's a cash outflow. Then we have operating expenses. In this case, question has just opted to generalize all the expenses into the operating expenses. But you all know that it's obvious that expenses will lead to an outflow of cash. And then we have, depreciation in our case doesn't constitute a cash outflow. Yeah, so you do not consider depreciation expense as a cash outflow. So one thing maybe that you need to note about preparing an income statement and a cash flow statement is that they follow the income statement follows the accrual basis of accounting. Yeah, with the accrual basis of accounting, we recognize expenses when they are incurred, regardless of whether cash has been paid or not. Yeah, so when an expense has been earned, whether cash has been paid or not, we have to recognize that expense. And that's why we recognize accrued expenses and we deduct prepaid expenses in the income statement, because you have to recognize expenses as and when they are being incurred, whether cash is being paid or not. The same case with revenues and incomes. And the accrual concepts, we recognize incomes when they are earned, regardless of whether cash has been received or not. So that is with the income statement. Unlike the cash statement of cash flows, which is prepared on the cash basis of accounting. So under the cash basis of accounting, we only recognize these activities, expenses, and revenues when cash has been has changed hands. We recognize an expense and a cash basis of accounting when cash has been paid. And for revenues and a cash basis of accounting, we only recognize this revenue when cash has been received. So that is in the cash flow statement, we follow the cash basis of accounting. In the income statement, we follow the accrual basis of accounting. So with that, then we do not recognize depreciation, because depreciation is not a cash basis. Yeah, it doesn't constitute a cash outflow. So we don't recognize depreciation in our case. And then provision for tax. This tax is also an expense to the business, and it constitutes an outflow of cash to the government. So it will also be under the cash flow is an operating activity. So it will be under the net cash flows from operating activities in our cash flow statement. Then sales will constitute an income, an inflow of cash from the customers. Yeah, so with that information, we can now prepare. Okay, let's prepare the first part of the cash flow statement, that is the net cash flows from operating activities, and we begin with the cash inflow from customers. So please refer to the notes that I've shared with you on this lesson. So we begin with the cash flows, cash inflows from customers. So cash inflows from customer, referring to the notes that I sent you, it's equal to sales for the year. Then we add opening debtors and less closing debtors. So we have this information in our financial statements. The sales can be found in the income statement. So we have sales of in our income statement 1.26 million. So we have them here. We record them. And then debtors, opening debtors and closing debtors can be found in the balance sheet on the asset side. So you have our debtors there. So the opening debtors is 84,000. The closing debtors is 93,000. So you have those figures there. So 84,000, and then we less 93,000 closing debtors. Now, and since we are lessing closing debtors, 93,000 shillings needs to be in brackets. We put it in brackets to show that we are deducting. So that information, you can now find the cash inflows from customers, being 1.26 plus 84,000 minus 93,000, which gives us 1251,000 shillings. Then we have the next item we have is cash outflows. Cash outflows to suppliers. Cash outflows to suppliers. We usually have cost of sales. Cost of sales. And then we add opening debtors, opening creditors, less closing creditors. Closing creditors. Then we add opening stock. Sorry, we add closing stock. Closing stock and less opening stock. So you have these items in the balance sheet. The cost of sales is in the income statement. So in our income statement, the cost of sales is 990,000 shillings. So we insert it here, 990,000 shillings. Then we have opening creditors. You can find them in the balance sheet. So opening creditors is 120,000. Closing creditors is 117,000 shillings. So we insert this opening creditors and less 117, which ought to be in brackets. Then we have opening stock and closing stock. These are items, these are found in the balance sheet on the asset side. On the asset side, so we have stock there. So we add opening stock, which is 48,000 shillings, and less less closing stock, which is 132,000 shillings. So closing stock is 48,000. Opening stock is 132,000 shillings. So we less 132,000 shillings. Closing stock, opening stock. Yeah. So with that information, now we can have our cash outflows to suppliers. So cash outflows to suppliers being equal to 990 plus 120 minus 117 plus 48 minus 132 gives us 909,000 shillings. So to the suppliers, that's a cash outflow. So it means 909 is moving out of the business. So you show it as a reduction. So therefore we have it in brackets. We have it in brackets. So minus 909. Then the other item that constitutes a cash flow from operations is wages and salaries. That is from our question. So then we have cash outflows, cash outflow to wages, salaries, cash outflow to wages and salaries. So in this case, we have the expense itself. So wages and salaries. Then we add opening wages and salaries due. Please refer to the notes on this. Less closing wages and salaries due. And if we have wages in advance, we add closing. If we have wages in advance, we add closing wages and salaries prepaid or in advance. And then we less opening wages and salaries in advance. And salaries in advance. So we have these figures in the trial balance in our financial statements. So wages and salaries, we have them in the income statement here on the expenses side. The amount is 120,000 shillings. So we have 120,000 shillings. Then we have opening wages and salaries due and closing wages and salaries due. These are liabilities to the business, so we'll find them in the balance sheet on the liability side. So do we have wages and salaries due? There is nothing like wages and salaries due. So both for the opening and closing, so we have 0 there. And then we have wages and salaries in advance, both the opening and closing. These are current assets, so they're supposed to be found in the balance sheet, but on the asset side. So, but I can't see any advances in wages and salaries. Can't see any advance. Yeah. So as such, we have 0 and 0 there. So therefore, wages and salaries in our case is 120,000 shillings. And since it's a deduction, it's an outflow, we show it in brackets. to indicate that it's a deduction, that something is going out of the business. And then we have the other item, cash outflows to operating expenses. So cash outflow to operating expenses. So in this case, we have the operating expenses themselves. The operating expenses, and then we add operating expenses due. We add opening. We add opening operating expenses. Please refer to the notes on these calculations. Then we less closing operating expenses due. Then we add closing operating expenses if we have in advance. So if you have operating expenses in advance, we add closing operating expenses in advance or prepaid. Then less opening operating expenses prepaid or in advance. In our case, these items can be found in the financial statements. The operating expenses is an expense which is found in the income statement. In our case, it's 40,000 shillings. So we have 40,000 shillings. Then we have operating expenses due. So we add opening operating expenses due and less closing operating expenses due. So in our case here, these are outstanding expenses are current liabilities. So these items can be found in the balance sheet on the liability side. So, and we have them here, outstanding expenses due. So we have the opening 12,000 and the closing 24,000. So we have them here. We put them in the cash flow statement. So we add the opening outstanding expenses less, and then less the closing operating expenses due, that is 24,000. And then we have the operating expenses in advance, both closing and opening. So we add closing operating expenses in advance and less opening operating expenses in advance. These expenses in advance are current assets, so they are found in the balance sheet on the asset side. So, and we have them here. We have advances, the opening 3,900 and 4,500. So we assume these advances are for the operating expenses because there is no other expense other than operating expenses here. So we assume these advances are just generalized, like we have operating expenses generalized in the income statement. So we're supposed to add closing operating expenses in advance. So the figure is 4,500. And then we less opening operating expenses in advance. So we less 3,900, which is the opening. So the opening is 3,900. The closing advances is 4,500. So with that, now we can have the cash outflows to operating expenses. So which will be equal to 40,000 plus 12 minus 24,000 plus 45 minus 3,900 shillings, which gives us 28,600. So this is another outflow of cash. So 28,600 needs to be in brackets to show that this is a deduction in our cash flow, in our cash account. So to 28,600 rupees. And then depreciation is not a cash flow, so we ignore that. And then we have provision for tax. These are an operating activity, so it needs to be here in the cash flow statement. So cash outflow to tax paid, that is tax paid. So tax paid is equal to the tax expense plus the tax expense due at the beginning minus tax expense due at the end of the period. So we have the tax expense, then we add opening tax due, and then we less closing tax due. So the tax expense is in the income statement. So you have it here as an expense, 44,000 shillings. So we key it here in the cash flow statement, 44,000 shillings. Then we have the opening tax due and the closing tax due. These are current liabilities to the business. We can find it in the balance sheet on the liability side, and we have them there. We have 6,000 opening and 6,600 closing. So we have them in our cash flow statement. So the opening tax due is 6,000 shillings. Then the closing tax due is 6,600 shillings. So with that, then we have a cash outflow to tax, which is equal to 44 plus 6 plus minus 6,600, which is 43,400. Any other activity, operating activity? So then we have net profit. That's not an activity. That's just a profit. And then profit on sale of building on the revenue side. Profit on sale of building. This is an investment activity. So we'll have it in the cash flows under investment. So with that, we have now our cash flows from operating activities. So we have cash inflows from customers, cash outflows to suppliers, cash outflows to wages and salaries, cash outflows to operating expenses, and you have the tax paid. Those are the only cash operating activities of the business during that year, as per the question that is. So we add them to get the operating cash flows. Yeah, operating cash flows, cash flow, or rather cash flows from operating activities. So therefore we have 1251 minus 909 minus 120 minus 28,600 minus 43,400. So 43,400 needs to be in bracket to show a reduction. And I've forgotten that. So therefore now, when you add all these activities and minusing as expected, we get our net cash flow from operations being 150,000 shillings. So as we have it there. So our net operating activity cash flows from operating activities is 150,000 shillings. Then now we move on to the second part of the income of the cash flow statement, that is cash flows from investing activities. So you can indicate it as B, that is cash flows, net cash flows, from from investing activities. So investing activities involve an business's investment, yeah. So when a business commits its funds in an investment, yeah, it's basically a commitment of funds with the hope of earning a return in the future. So businesses usually invest in fixed assets, like it can acquire a motor vehicle, machinery. This is considered to be an investment. So we'll under investing activities, we look at the fixed assets, the change in the fixed assets. The change could be as a result of buying an asset, or it could be as a result of selling the asset. So buying would lead to an outflow of cash. selling will lead to an inflow of cash. And the change could also be as a result of depreciation. So you need to take into consideration this depreciation. And you also need to take into consideration revaluation. Revaluation and depreciation do not constitute a cash flow. So you need to take into consideration those four items. That is a purchase, the sale of a fixed asset, the depreciation, and revaluation of an asset. Yeah, when trying to determine, yeah, because in most cases in the examination questions, the question doesn't give you a direct information that the asset was acquired at this much. It will give you the depreciation, the opening balance of an asset, the closing balance of an asset, and maybe something to do with revaluation, depreciation, and a profit, like we have in our case, profit on sale of building. So those that information, then you're expected to work out and determine and tell whether the business bought or sold a fixed asset. And then another thing, apart from fixed assets, another investment could be in marketable securities like shares, like treasury bills and bonds. So you also need to look out for these marketable securities. In most cases, they are found on their current assets. Their current assets. So you also need to look out for those. That could be an investment by the business, yeah, to earn a return from dividends in other companies, or by selling shares in the stock market, it may get a capital return, which could be at a benefit to the business. So therefore, we look on our asset side, fixed asset side. We have land, we have buildings. So in our case, in this question, we consider this to be the investments of the business. So under the current assets, I don't see any investment. Yeah, these are just the normal operations of the business. So therefore consider land and buildings. So net cash flow. So we have, we consider land. So we have net cash flow. Net cash flow from sale stroke. Okay, maybe I put it in brackets, sale from or purchase of land. So in our case, we have land. At the beginning, it's 24,000. At the end, it's 48,000 shillings. Do we have any other additional information concerning land? No. Okay, we have depreciation here, but it's not specified depreciation is on what, but we have two fixed assets, that is land and buildings. Yeah. So we'll assume that this depreciation is for buildings. Yeah. You know, in most cases, land does not depreciate in value, so this depreciation doesn't apply to land. Yeah. So therefore, land, there's no any further additional information on land. Yeah. And we have not been told whether this land was revalued or not. So we assume this is the increase is not as a result of revaluation. So therefore, we assume that this increase in land is as a result of acquiring more land, which must have been through buying the land, which constitutes a cash outflow. So therefore, in this case, land has increased in value as a result of buying through a cash outflow. So therefore, in this case, we have opening what? Land, we can say land at the beginning, opening land. Opening land is, in this case, is 24,000 shillings. Sorry, 24,000 shillings. Then we less closing land. That is land at the end. Closing land. So that is land at the end. So we less the land at the end. In our case, it's 14,000 shillings. So by deducting it, this amount needs to be in brackets. So 14,000 shillings in brackets. So our land is, therefore the difference between these two is 24,000 shillings. Yeah. So land increased by 24,000 shillings, which in this case, we are sure that this is by buying the land, which is a cash outflow. And then we have our buildings. Buildings have also increased in value from 180 to 288, but we have some other complicating information. We have provision for depreciation on buildings, as I've highlighted there, 60 and 66,000 shillings. And then we have some depreciation here in the income statement, which is relating to the buildings. And then we have profit on sale of buildings. Yeah. So this information complicates our determination of on whether buildings were purchased or not. So we need to work out that. So that we have in our case maybe net cash flow from what? From purchase strokes from sale stroke purchase. Purchase in brackets, indicating that you're deducting. Cash is going out. Purchase of buildings. Purchase of buildings. So we want to get whether there was a cash outflow or cash inflow for the buildings. So back to our previous semesters, I think in the unit principles of accounting 2 or financial accounting or intermediate accounting, I believe we must have covered accounting for fixed assets, and in that topic, disposal of fixed assets. So when it comes to disposal of fixed assets, the accounts that are opened, one, we need to open a disposal of assets account. And we also need, which will affect the assets account itself. It will also affect the provision for depreciation on assets account. It will also affect the bank account. So in our case, to determine the effect, whether there was a purchase or sale of land of buildings in this case, we need to relook at those those accounts that will be affected. That is a what? That is a disposal of asset account. So you open the various accounts affected. So you have the disposal of buildings. In this case, it's a building being affected account. It's an account that is being opened to account for the building that is being sold. So you open an account for buildings, and then so we enlarge that column. Then the other account that is to be affected by these buildings disposal is it's called the provision for depreciation on buildings account. Provision for depreciation on buildings account is another account that you need to look at in this working. Then we have the other account being affected is the building itself account. The buildings account. We also have bank account, but we will not open a bank account in our case, or cash account. Let's deal with only these three accounts. Yeah, let's deal with only these three accounts. There is a disposal of buildings, provision for depreciation on buildings, and buildings account. So disposal of buildings account. Okay, first of all, let us put the information in the provision for depreciation and buildings account, and then we adjust our disposal of buildings account. So we have our provision for depreciation on buildings in our balance sheet, as I've highlighted there. So at the beginning, the provision for depreciation was 60,000, and in the end, it's 66,000 shillings. So therefore, we can say that our balance of provision for depreciation account is brought down at the beginning of the month. The balance brought down is 60,000. Yeah. And then the closing balance is 66,000 shillings. So at the end, the buildings account will have a balance, the closing balance of land. So balance carried down being equal to 66,000 shillings. And then we have the buildings account. At the beginning, the buildings were 180,000 shillings. At the end, it's 288,000 shillings. So we have this information in our balance in our buildings account. So we have a balance carried down being 180,000 shillings. Sorry, 180,000 shillings. 80,000 shillings. And the balance, so the balance brought down. The balance brought down. At the beginning is the balance brought down. At the end, we have the balance carried down. Carried down is 288,000 shillings. Yeah. So the closing balance of buildings is 288,000 shillings. Yeah. And there is a mistake I've done. Please let's correct this. For buildings being an asset, the opening balance is usually on the debit side. The closing balance is usually on the credit side. For the provision for depreciation on buildings, this is an account that reduces the value of buildings. So when a building being an asset, when it's going down, is supposed to credit. So for this account, the opening balance needs to be on the credit side, while the closing balance should be on the debit side. So let's change this. So the balance brought down on buildings should be on the credit side, and the balance carried down should be on the debit side. So please note the correction. So opening balance on depreciation on buildings should be on the credit side, and the closing balance should be on the debit side. So that is buildings. And then the other information that we have is in the income statement, we have depreciation the annual depreciation, yeah, on the buildings. So 30,000 shillings. So this annual depreciation on buildings should increase the accumulated depreciation on the buildings. So the provision for depreciation on buildings should go up. So which means that this depreciation on the annual depreciation should be credited in the provision for depreciation account. Yeah, because this is a decline in the value of the fixed assets. So we close the depreciation account by crediting it in the provision for depreciation on buildings account. So we credit here the annual depreciation or the depreciation during the year, the annual depreciation or depreciation during the year, that is in our case 30,000 shillings as seen in the income statement. So depreciation during the year is 30,000 shillings. So therefore the annual depreciation is 30,000 shillings. And then the other information that we have to take note is a profit on sale of building. So the profit on sale of building is usually seen in the disposal of buildings account. But before we get there, we have in our additional information that a building during the year whose cost price was 36,000 shillings was sold. So that 6,000 shillings is a deduction in the building's value. Yeah? So as such, this will be deducted from the buildings account. The buildings account will go down, and it will go down by crediting the buildings account and debiting the disposal of buildings account. Therefore, you credit the buildings account using the disposal of buildings account. The disposal of buildings account, in this case, the buildings will go down by 36,000. So since we have credited in the disposal of buildings account, we therefore debit the disposal of buildings account. So disposal of buildings. This is by now buildings, yeah? Buildings account. So 36,000 shillings. We ought to debit there. And then the other thing that has to come here is the depreciation on buildings. The depreciation on buildings. So to determine to find the depreciation that, okay, we have the accounts, our accounts here. Okay, so, before we get there, we have the profit on sale of building. The profit on sale of building is usually determined in the disposal of buildings account, and you normally find it on the debit side of the disposal of buildings account. You normally find it on the debit side of the disposal of buildings account. So we have gain. So we have it gain on sale of building. Gain on sale of building, which has been given in the question, is 6,000 shillings. So 6,000 shillings. Then with that information, with our accounts there, we can balance them off. So our buildings account will, okay. Yeah, so we balance off. Okay, we begin with the provision for depreciation on buildings. So we see the difference. The difference will be by disposal of buildings account. No, sorry, by disposal of the buildings account. So we balance off this account. That is a provision for depreciation on buildings. So the debit side is a total of, okay, the credit side is heavier. So therefore, our totals will be 9,600. No, sorry, not 96, but 90,000. So 90,000. So the difference here is 90,000 minus 66, which is 24,000 shillings. So this has to be this now the 24,000 shillings. That is the balancing figure here in our case, is the depreciation on the buildings that were disposed during the year. So this will go to the disposal of buildings account. Please refer to the area unit, disposal of buildings account. Yeah. So 24,000 shillings is the depreciation on the buildings, the accumulated depreciation on the buildings that is being disposed. So being that it is being debited here, then we debit it in the disposal of buildings account. So this is by provision. So we credit the disposal of buildings account by provision for depreciation on buildings, so which is 24,000 shillings. 24,000 shillings. So then now we balance off the buildings account. balance of the buildings account, disposal of buildings account. So the debit side is heavier in our case. It's heavier than the credit side. So the total of both sides is 36 plus 6. 6 plus 6, that is 42,000. So we find the difference here between the two sides is that is 42 minus 24,000, which is 18,000. So 18,000 is not the balance carried down. The disposal of buildings of asset account, that it should not have a balance carried down. It should balance off. So in this case, the difference here must be via the bank account. Yeah. So when we are disposing of a fixed asset, we use the disposal of buildings account, yeah, which will help us get the gain on disposal of buildings. So in that account, we debit the asset that is being disposed at its cost price. We credit its accumulated depreciation, and then we credit the bank account or cash account, yeah, cash account. So cash account. So in this case, this means that this is a cash that is coming in. So since we are crediting it here in the disposal of building account, it is being debited in the cash account. So to show that cash is coming in. So this will be via sale. So in brackets, sale of buildings. Yeah. So sale of buildings. So we're able to tell now that buildings were sold at 18,000 shillings. Yeah. So the buildings sold at 18,000 shillings. So this is a cash inflow. Then we balance off buildings account. So we are seeing that our balance carried down in the buildings is 288,000 shillings. And the opening balance is 180,000 shillings, and the disposal of a building worth 36,000 shillings was disposed during the year. So the two sides are not equal, so you need to get the difference. So the two sides, so from the look of things, the credit side is heavier. So the total of both sides shall therefore be 324, and the other side also the total shall be 324,000 shillings. So there's a difference of how much? 324 minus 18, 180,000. That is 144,000 shillings. So this is an increase in buildings. Yeah, since it's on the debit side, this must have been by cash. Yeah, means that buildings were bought during the year. So you can have it in brackets, purchase of buildings, which is an investment. So buildings were purchased during the year at 144,000 shillings. So from our calculations, we can see that. So the increase in buildings in this case is 144, that is via purchasing, which is an investment. So both of these activities are cash flow, constitute a cash outflow and cash inflow. So we can have then sale of buildings. Go back to our cash flow. We have sale of buildings being an investment activity. Sale of buildings. Sale of buildings, we've been able to see the sale of building is from the disposal of buildings account is 180,000, is 18,000 shillings. So buildings worth 18,000 shillings or are sold at 18,000 shillings, and we have purchase of buildings. Purchase of buildings, which you can also see from our workings. Purchase of buildings is 144,000 shillings. So less 144,000 shillings. So therefore, the net cash flow from purchase or sale of buildings is equal to 118 minus 144, which is equal to, sorry, it's 18,000 minus 44,000, which is equal to 126,000 shillings. So that is all about investing activities. So we have net cash flow from a purchase of land, and cash outflow from sale and purchase of buildings, which in total will be equal to minus 24 plus minus 126, which is equal to 150,000 shillings. So we less that amount. So by deducting, we show it in brackets to show that the net cash flow from investing activities uh, uh, is negative. So it resulted to an outflow of cash for this example of ours. Then we move on to part B, part C. We've now exhausted our investing activities, because we only had buildings and land, and there is no investment in current assets. There is no activity that indicates investment. So these current assets basically represent the normal operating activities. Then we have the final item in our cash flow statement, final classification, that is net cash flow from investing. Not investing, but financing activities. So net cash flow from financing activities. So financing activities are basically those activities in which a business funds itself, in which a business obtains financing or funds. Yeah, and financing or funds are usually found in the liability side. And on the liability side, we look at the long-term financing. So look at the long-term debt. Yeah, long-term debt that's finance the business, or even bank loans. Yeah, those are financing activities. And the major financing activity is from raising share capital. Yeah. So therefore, in our case here, on the liability side, we have share capital, which is a business's finance. Yeah. In this case, so an increase in share capital represents something. Maybe the business obtained more finance by selling shares to the public. And then down there, I don't see any other financing activity. Yeah. So the only financing activity here, in this is the share capital, the increase in share capital. So the increase in share capital in this case the share capital has increased from 180 to 222, indicating that more money came into the business, yeah, during the year to finance the business. So the increase in share capital is a cash inflow. So increase, so we can have the increase in share capital. So increase in share capital. So it is opening. We have opening share capital. And then we less closing. Sorry, yeah, less closing. Okay, let it be closing share capital. Share capital less closing share capital. So the closing share capital in this case is 322. Then we less the opening share capital, less the opening, not closing, opening share capital. So we less the amount is 180,000 shillings. So we put it in brackets to show that we are deducting. It's yeah. So cash flow has the capital of the business has increased from 180 to 228, which is indicates a cash inflow. So therefore, we have it like that. You don't have it in brackets because this is an increase in cash. Yeah, when you obtain a loan from the bank, for example, it means our cash balance will increase. Yeah, and the same case applies with capital. When the owners of the business bring in more capital, it means that cash is increasing in the business. So therefore, 42,000 shillings will be an increase in capital and in cash. And then another thing we need to look for is that we have in our question here, dividends proposed. Yeah. So dividends being paid to the shareholders. Yeah. This will be in regard to the investment, to the financing that the shareholders have given to the business. So therefore, the proposed dividends will be a financing activity. So we need to determine the cash outflow to dividends being paid. So therefore, we have dividend paid. So refer to the notes that I've sent. So to get the dividends paid, we have the dividend itself, dividends, add, and then we add opening dividends payable or accrued minus the closing dividends accrued. So you can refer to the notes, opening dividends payable and less closing dividend payable. So in our case here, the dividends proposed, that is the dividends proposed, we can find them in the income statement. So you have them in our income statement. It's 36,000 shillings. So you have 36,000. And then opening dividends payable and closing dividends payable. These are current liabilities to the business. So you can find them in the balance sheet on the liability side. So do we have dividends payable? No. So therefore we have 0 and 0. So therefore our total cash outflow to dividends payout is equal to 36,000 shillings. That is 36,000 shillings in total. And then this is a cash outflow to the business, so we have it in brackets. So that 6,000 shillings is we put it in brackets to indicate that it's cash going out. So then now we have our two items in the financing activities. That is the increase in share capital, which constitutes an inflow of cash, and dividends paid, which will constitute an outflow of cash. So in total, this will give us 42 plus minus 36, which is 6,000 shillings. In this case, it's positive, meaning that the net cash flow from financing activities was an increase of 6,000 shillings. So, and with that, we have the total of, cash flow items that from the operating activities. Yeah, from the operating activities, that is 150,000 shillings. And then from the investing activities, that is negative 150,000 shillings. And from financing activities, that is 6,000 shillings. So if we add these activities, all this, we'll have the net change in cash and cash equivalents. So the net change in cash, the cash balance. The net change in cash balance will be found by adding the net cash flows from operating activities, from investing activities, and from financing activities. So from operating activities, the total is 150,000 shillings. From investing activities is minus 150,000 shillings, and from financing activities is 6,000 shillings. So in total, so it's 150,000 shillings plus minus 150,000 shillings plus 6,000 shillings, which is a total of 6,000 shillings. So to this, we add the cash balance at the beginning. So we have cash balance brought down. So at the beginning, it was how much? So you find that in the balance sheet on the asset side. So on the asset side, the cash at the beginning was 30,000 shillings. So you have it here. So you have 30,000 shillings. So you have it in the cash, in the balance sheet. Yeah. So 30,000 shillings is the cash at the beginning. So which will give us, when you add the net change plus the cash balance at the beginning, it gives us 36,000 shillings. So we highlight that, we put it in bold also. So this will be the cash balance at the end of the period, uh, carried down, which is 36,000 shillings. So, and if we check, if we go back to our balance sheet, the closing balance of cash, that is the cash brought down, is 36,000 shillings. So, which is the same as what we are having in our cash flow statement. So, which our cash flow statement should balance off that way. That is, the cash balance carried down should be equal. The cash balance carried down in the cash flow statement should be equal to the cash in the balance sheet. And with that, we have our illustration on how to prepare a statement of cash flows. Thanks for bearing with the long time that I've used to prepare this statement. Thank you.